Good day, and thanks for joining us for our webinar on the Ag Business Climate Outlook for 2018. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture, and joining me on our webinar today are my colleagues, Dr. Chris Hurt, a professor and extension economist here at Purdue, and Michael Langemeier, who's the Associate Director of the Center and also a professor of Ag Economics here at Purdue. So we want to talk about several different things here with respect to the outlook, and we're going to start off talking a little bit about the U.S. economy and the macro effects, and then we'll drill down a little bit more, talk about what's taking place in the crop side as well as the livestock side, and then at the conclusion maybe draw some inferences with respect to some management recommendations as you look ahead for the 2018 crop year and calendar year. So Chris, let's talk a little bit about the macroeconomic environment. There's a lot to talk about here, a lot of changes coming in at the end of 17. And truthfully, a lot of things that could spill over and have an impact on the ag side.
Well, we always start, when we do Outlook, we start with the big picture, and that is what's the income going to be? And obviously domestic income, but foreign income, since we export in the U.S. about 20% of all the ag products we produce, the foreign sector is really important. And when people have income, they do tend to buy more, and that's even true of some agricultural goods. So what we have at this start of 2018 is a really robust U.S. economy. And as we talk about that nature of that robust economy, we had increasing growth rates in 2017. And it looks like, at least the anticipation is, we're going to add to those growth rates here in 2018. That overall is a good picture, a positive picture for the general economy, for our consumers. And that we are hopeful will help provide at least a little bit of support for the agricultural community. But as we think about the strength of the macroeconomy, we also are talking about the full employment that we see in the U.S. Most all of the workforce people that have been out of work are back to work at this point. We look at the Tax Reform Act, the new tax law, and that actually looks quite stimulative. And we're going to show a picture of that helps you understand how stimulative that's going to be. Now again, that doesn't say every consumer is going to have more disposable income, that is the withholding from their tax from their income for taxes will go down, but I think a lot of consumers will see a benefit there. And businesses are going to get a lot of stimulation out of this new tax reform as well. And clearly we have seen that in the equity market, in the stock market, setting new record highs consistently throughout 2017, and then starting out this year in a most robust way without question. And reducing those taxes has substantial increase in the value of the stock, the value of those companies, when essentially the federal government will not require nearly as much income tax for them to pay. So obviously what we see in the U.S. economy is this strong demand for many products across the board, and the resources to provide those, like the plant capacity that we have, the number of workers we have, we're really pushing up against limits there. So what that says, we're probably going to see faster wage rate growth. We have seen wages moving up over the last few years, but that's probably going to accelerate in 2018. Again, good for consumers. And many of them get to keep more of that in their take-home pay. I think, again, housing has really recovered, and we're going to see a strong housing market as we go through 2018. And some of the negative consequences of this are that we're going to see increased inflation, which has been very much at bay, 1.5% to under 2% most recently. But this demand pressure on wages, demand pressure that may cause housing values to go up and other prices, we're probably going to see higher inflation. And while the Fed is working towards normalizing, bringing interest rates back up, I think we'd say with the strength of the economy, this really provides more incentive to say, yes, they will increase, probably at least 3 times 0.25% as we go through 2018, the short-term interest rates. So it's a very good, one of the best years we start out that we have for the general economy and the world economy. We have the best year in the world economy since the 08-09 recession. So from a demand standpoint, income standpoint, it doesn't get much better than this year in 2018.
Yeah, so let's kind of summarize there, Chris. I think you just made a strong case for a very strong domestic economy, stimulating demand for all products, but one of those obviously being agricultural products. Strong demand because of income growth around the world, being supportive of our exports around the world. So that's very positive. If there is a negative in this outlook for agriculture, it's probably on the interest rate side, right? More pressure on the Fed to raise rates, perhaps a little faster than maybe what people were thinking a few months ago.
Well, I think that's right, and there are some other possible factors that could be very negative to agriculture. And I think we're going to talk about the agricultural economy and why it's in really contrast. I think everybody knows the ag economy from a farm income standpoint is depressed, and that's not going to turn around substantially in at least the first half or first 3 quarters of 2018. So we want to talk about why the ag economy is not doing so well relative to the general economy.
But in terms of this positive macro outlook, really the only negative spillover impact would be the potential, and I really want to emphasize potential, to push interest rates up maybe a little more rapidly than what we had thought a few months ago.
If we do see the movement towards inflation, then I think the guess is that you're going to see more investment in commodities as a inflationary hedge, and that would bring commodity values up, and probably that would include the grains. So I think it is interest rates would be the negative factor. Inflation would probably overall be positive to the agricultural economy. Okay. I think we had a visual on the tax rates.
Yeah, let's take a look at that.
Because I think it helps people to see what kind of incentives might be coming. And what we have here, the blue line is the tax rates from the old tax law. The orange line is the new tax law that has just gone into effect. And so if we'll start over towards the left-hand side, on the bottom axis, we're looking at taxable income. So under that 15 and 12%, that's kind of the midpoint of that's around $50,000 of taxable income. And you can see the tax rate there was 15%. It drops to 12%. So this might be a family that one person's working, or maybe it's 2 people working at a relatively low wage rate. And there is a 3% savings on their tax, so that certainly is somewhat positive. If you calculate that out, it's about $900 to $1,000 a year. So for that family, you're thinking, let's just round it off to around $100 more that they have in their paycheck. Now, I've got to back up here when we talk about taxes. And to say that it will depend on the number of children they have, how they've handled their standard or itemized deductions. So, but if we're just looking at taxable income on the effect of the tax brackets and the rates, that's about $1,000 of savings or higher returns for a family that's making around $50,000 of taxable income. I think that does make a little bit of difference. It is stimulative to the economy. If you get out to the next bracket, let's go to the 22 to 25, around $100,000 of taxable income, and these are all married filing jointly. That's about $2,500 of potential tax savings, and that's about $200 per month. And I think that does begin to say that you're going to see a consumer effect from these higher incomes from the taxes, especially for those families that do have those. Now, when you really look at some of the higher income, I just went out to about $300,000 over on the right-hand side. Those rates drop from 33% to 24%. So now you're looking at $14,000, $15,000 of reduced taxes. That's a substantial amount. Then let's go over to the corporate tax rates. The corporate tax, which we're not showing here, but they go from 35%, which would be, look at the right-hand side of that graph, that would be higher than the 33, and dropped to 21%. So a huge benefit for corporations that are paying taxes. So I think it's really pro-business, and I think it's really pro-farmer business favorable, this tax law, which we'll be learning more about. But here's an additional stimulus that we have to the economy for 2018.
A very kind of a classic Keynesian demand boost to the economy going forward. And it's going to take a little while for people to figure out where they're at with respect to this tax bill. But as 2018 unfolds, people become more aware. That's when that impact is likely to kick in.
That's right. And again, there's been a lot of push on IRS to get this in place, the new withholding tables, by February. So many consumers, and particularly the politicians in control of the Senate and the House and the presidency now, want consumers very quickly to get the message. Many of you are going to have more disposable income. Reduce that withholding, a bigger paycheck. That'll show up probably sometime in February.
All right, let's turn our attention and talk a little bit more specifically about the ag outlook. And we've got some key points we want to make as we before we start going through some of the charts, Chris.
Yeah, and I think really what the contrast is, such a robust U.S. and world economy. At the same time, we have an ag economy that really is struggling in terms of farm incomes. The big reason for that, everybody knows, U.S. and world grain inventories are very large. Those inventories are a weight to the marketplace at this particular point, and low prices are the consequence of that, and low farm incomes. We're going to see the U.S. animal industry back to work and basically into full production in 2018. Generally, when we see supplies increasing, we'd expect weaker prices that would tend to push incomes from the animal sector lower. But again, Jim, I think you're going to talk a little bit about, will the strong demand for animal products be able to offset this growth in supply? So that's a question mark we still would have at the beginning of the year. One of the red flags that gets thrown up very quickly are trade concerns for agriculture. And we know how important trade is and the depressing impacts. If we would lose some of our trade opportunities, how depressing that would be to prices even more. But obviously the NAFTA renegotiations are going to be very important and critical to agriculture. We do know on the geopolitical side, North Korea, Middle Eastern issues, that certainly could wreck some of this very strong world demand that we're talking about. China's always in the mix with especially North Korea and the problems there. But with other issues, China could be as well. And again, we've seen the administration turn to a U.S. first or America first policy. And while that has benefits, it could also have backlash. Countries like Mexico, where that's our #1 corn export destination for U.S. farmers. Mexico is saying, well, we maybe can't rely on the U.S. for that corn. We're going to be in talks with Argentina and Brazil to supply more of our corn. So I see that as certainly a hazard going forward. And then, what could come along to make ag prices better, to say that these big inventories aren't going to continue to just drag down prices and give us low farm incomes? Well, I think one you brought up, Jim, and that was, what if inflation does start to pick up more? And I think there's going to be a lot of the investment community looking at the size of gains in the stock market and saying someplace probably in 2018, the stock market has a potential to run out of steam or to get overinflated. And then that may see a turning away from equity investments, some reduction there, and looking around the world, what is cheap? What is undervalued now? Well, when you look at corn and soybeans and wheat, I think that's going to be very quickly one of the groups of investment opportunities that investors are going to say, there's a set of opportunities to invest on prices that are very low. When you're looking at 5-6 year lows on some of these prices, that is a real opportunity. So some of that commodity investing could begin to bring us back. Then we've had very good weather for the last 4 years. And I think while none of us know when weather might be unfavorable, we clearly have some indications in South America that there will be at least continued concerns going through their growing season. And then we start out with the United States at this point that remains very dry certainly in some important production areas. So will we talk weather in 2018? To be determined, but it's certainly one of the things that can turn us much more favorable in terms of prices.
And I think one thing that you pointed out there, Chris, that I think is underappreciated is the impact of this 4-year run of pretty favorable weather in terms of U.S. production, not only in the U.S., but actually in some other countries as well. That's had an impact on allowing us to rebuild these grain inventories pretty substantially and lead to those weaker prices. And that doesn't have to continue.
No, that's right. And again, we generally believe weather may go through periods, multiple years and consecutive years of good or harmful, but that eventually you retreat back to more some average kind of conditions over time. Again, we'll see how that works out, but in agriculture, we know weather is always one of the main factors. But just because it's been good 4 years in a row for weather doesn't mean we'll have 5 or 6 or 7 in a row.
That's right. Well, Chris, you mentioned what's taking place in animal agriculture. Let's take a look at that. This is a chart that looks at beef, pork, and poultry production in the U.S. on a combined basis, going back to 2000. And we've really had a big change here. If you look at that chart for a little bit, you see how production levels kind of stabilized in that 07, 08, 09 going forward up through about 14. And then since then, we've really been in a rebuilding phase. So we had some challenges in animal agriculture, a lot of that revolving around dramatic increase in feed cost, pushing up cost of production, really held back growth in the industry for a number of years. But now that we've seen grain prices come down, profitability returned to much of animal agriculture, we've rebuilt those sectors and expanding continuously now for 4 years in a row. Production this year expected to increase about 2 to 3% compared to last year across those beef, pork, and poultry sectors. And I guess one other point to look at just over the magnitude of this chart going back to 2000, it's instructive to think about how much bigger animal agriculture is in the U.S. today than it was roughly 20 years ago. In the early part of the century, we were a little over 80 billion pounds of production. Now we're over 100 billion pounds of production. So in round numbers, an increase of about 25% in roughly 2 decades. So animal agriculture is an important determinant of feed grain prices in particular as you look ahead. Growth in animal agriculture means growth in feed usage, so that's positive for grain prices longer term. And I don't see that slowing down here in the next couple of years, particularly as we continue to see these positive income numbers not only in the U.S. but around the world, because as consumers, especially in importing countries, see their incomes grow, one of the things they like to do is continue to change their diet, improve their diet, if you will, by consuming more animal protein. And I think that's very positive for meat exports over the next several years if we continue to see that positive income growth.
And we have to maintain that emphasis on exports, and this is where the renegotiation of NAFTA, as well as other America First kind of policies, makes us nervous in agriculture.
That's exactly right. That's exactly right. And I think it's probably not widely appreciated how important those NAFTA countries are from the meat export standpoint, Mexico in particular, but also a lot of cross-border trade with Canada as well. So this next slide looks at things in a little different perspective. Instead of looking at it in aggregate numbers, this looks at that red meat and poultry production on a per capita basis. And that's the per capita supply facing U.S. consumers, if you will. So 2 things that are accounted for in this chart that are not in the production chart. One is it accounts for population growth here in the U.S. The other thing is it accounts for the net trade flows, imports and exports. And when you account for those 2 things, the per capita meat supply increase that we're expecting in 18 versus 17 is smaller than what the production increase is. I said the production increase probably in the ballpark of 2 to 3%. On a per capita basis, we're probably going to see supplies increase 1 to 2%, and it might wind up being a little closer to 1 than 2. So when you think about, you had a question mark on that early slide, Chris, about weaker prices. Normally with a supply increase like that, we'd be looking at expectations with stable demand of weaker prices. But we've laid out a case for strong domestic demand growth, potentially impacting livestock prices, and strong international demand growth as well. So when you look at it in that context, actually the price scenario, even with the supply increase, probably suggests maybe prices holding about steady on an annual average kind of a basis going forward, and not as negative as you might think just looking at the supply side alone.
And on the feed cost side, fairly similar feed cost in 18 versus 17. So if demand can hold these prices on animals, at least we wouldn't dip on animal incomes.
That's right, that's right.
But again, we do have a potential, if that supply is the dominant side, that we would dip some on prices and lower animal incomes in 18 as well.
Yeah, I think the key here is we're expecting some demand growth coming out of those income numbers, not only in the U.S. but around the world. One other thing to look at with respect to the meat side, and I think it's useful to think about, if you think about that previous slide, per capita meat supply numbers, and I'll just flip back to that real quick. A few years ago, there was a lot of people questioning whether or not we would push U.S. meat consumption back to the levels we saw in 04 through about 07. In other words, push those per capita meat consumption numbers up above 220 pounds per capita. And it looks like we're on track to get back to those kind of consumption numbers on a per capita basis here in the U.S. We're not going to hit it in 18, but perhaps looking ahead to 19, we might do that. But as you think about it, as we've rebuilt those supply numbers, increasingly we continue to shift our consumption over to the poultry side. Poultry's share of U.S. meat consumption 50 years ago was a little over 20% of total meat consumption. In recent years, it's been about 50%. On the chart, it looks like it's kind of leveled off there the last couple of years. Part of that's because of the fairly rapid buildup in to some extent, pork, but especially beef supplies. Longer term, I think that trend is still in place. U.S. consumers are clearly have a strong preference to move their meat consumption towards poultry, and we don't see that slowing down. But that's a big change that's taken place over many, many years, and it's a trend that remains in place as best we can see looking out into the future.
And on a global basis, similar kind of trends. The growth is really in chicken and pork. Those are really economic products to produce, and we think that's going to be the case going forward. Beef continues to struggle. World total usage will grow, but pork and chicken will probably outpace beef.
I agree, and you can see that when you look at the export numbers. That's been dramatic, especially on the pork side over the last 10 or 15 years, the dramatic growth in the importance of pork exports to the pork industry. So with that, Chris, let's drop back again and talk a little bit more about this broader impact on commodity prices that you brought up in the opening.
Yeah, so the question is, will corn prices follow the general commodity trend? So we've got a long-term chart. The dates are kind of hard to see on this chart, but this is a 15-year chart, so we go back quite some time. The blue bars are commodity index. It is the Goldman Sachs commodity index. And so you can see the peaking in 2008 of that index. Again, oil is in that, metals are in that, agricultural commodities are in that. The orange line is corn price. And we've got an arrow pointed back to a time period in 2004, 2005, moving into 2006. And what we want to reflect there is on the blue line, the blue bars, that we already had general commodity prices headed higher in 2004, 5, and 6. But the orange line, corn, remained very low. That's really back in the $2 corn era. Now, what's going on there is that the general tendency for commodity prices to come up was in place, driven by the entire economy, world economy, driven by the availability or supply of overall commodities. But corn had very high inventories, a time period that we're in right now, very high inventories, and prices didn't really recover until we got into late 2006. So a little bit to the right of the arrow where you see the orange line begin to move up. That's when we tighten down on the supplies of corn, and then prices finally respond. Now let's go to the right-hand side. And on the right-hand side, we've got the lowest of the blue bars comes in early 2006. This was 2 years ago that we saw oil prices $25 a barrel. We've more than doubled that. We've seen world demand be strong for metals. We watch copper in particular, and we've seen strong increases in copper prices. But if we look at the orange line, we haven't been able to see much recovery in corn prices. The reason for that is we have big inventories of corn. What we can get from the long-term picture is that over time, corn prices tend to follow the general commodity direction. But in the shorter run, in the 1 or 2 years time periods, we may see corn lower or higher than what that general index is showing. So what I think, again, we introduced this concept, commodities, if you're looking for something to invest in around the world other than equity markets, the agricultural commodities, particularly the grain commodities, would be some of the ones you would highlight as these are really low values. Now, we've got an issue of too large of inventories. So we're going to have to change the picture on U.S. and world inventories before we can really get major recoveries on grain prices.
Nice segue. We're going to take a look at those inventories.
So, how did that get in there?
here's the ending stocks to use ratios for corn, soybeans, and wheat in the U.S. And we're going to take a look at the world in a minute. But these are the U.S. numbers. So talk us through those, Chris.
Okay, so green line is wheat. And this is measuring at the end of the marketing year when we're ready to harvest the new crop, what percent of a year's supply is left over, unused. And you can see wheat has been up near 50% in this 17-18 marketing year. That has come down, but still these are dramatically high numbers. They're really, we had been the highest in 30 years. So wheat, we're a little progress, but still a very high number. The blue line is corn. We're the highest inventories in 12 years on corn. And those inventories in the U.S. have been increasing for 1, 2, 3, 4, 5 years. And guess what's happened to the average corn price for the last 5 years? Lower, 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 lower. So successive years of lower prices as we build inventories. Soybeans, we've had, we're at the high, that's the red line, I should say. And we have the highest inventory in 11 years. And remember, in the last 11 or 12 years, some of those years we had very low inventories and very high prices. But this is our issue. When agricultural commodities like crops have big inventories, there's just not a desire for the world to inventory that. Let the U.S. farmers inventory that. So this is the picture that gives us the, I think, general direction on prices. We have to turn those inventory numbers downward to really get major recovery in corn, soybeans, or wheat prices. These are U.S. the picture.
Yeah, so let's take a look at the world numbers.
Little different picture here, not for wheat. Again, very large inventories in the world. The green line is soybeans for the 17-18 marketing year. Using USDA's numbers, we've got a downturn in inventories, fairly modest. But there are problems now in South America. We're seeing some private estimates of reducing the size of the soybean production from what USDA has in South America. So that could help improve the stock situation for the world on soybeans even more. The red line is corn, and here we see 2 years already, the 17-18 marketing year that we're in now. The last observation on the right-hand side of the red line, second year in a row of reduced world inventory of corn. And I think this is a very encouraging sign. Encouraging in the sense that if we have the prospects of reducing that again in 18-19, then I think you're really beginning to talk about stronger corn prices. Bean prices may struggle to increase, but really improvement in that corn situation for the world. Now, if the world's inventories are going down on corn, but U.S. up, That obviously says the U.S. is the one that's carrying more of this inventory at this point.
A couple things here, Chris. We're not near as low in 17 and 18 as we were in 11, 12, and 13. And so when we talk about stronger prices, we need to keep in perspective.
Modest increases.
Modest increases in prices. Another point I wanted to make, and we don't have that chart with us today, but the rest of the world has really ramped up their ability to produce wheat and corn in particular, but also soybeans. And so there's a lot more acres out there of these crops than there was even 5 years ago. And so that's important to keep in mind when we're looking at these world stock numbers.
And let's follow a little bit Michael's point there and focus on the corn, the red line. How do you get the inventory amount at the end of the year to come down? That says for that year, the world ate more corn than they produced. Yeah. So here's the key, and that is to get successive years of consuming or eating more than you produce.
Very strong demand.
So the supply is in those numbers, the higher production's in those numbers. So I think there's an encouraging picture here. On corn, really what has changed is China. China has had very high inventories on corn. A couple of years ago, they got to the point they had about over 50% of the entire world ending inventory on corn. So they are in the process of reducing that at this point. But again, that happened back in 2003, 2004, and 2005. China got very high inventories of corn. They started reducing, and that's when the world got their inventory cleaned up, and we began then in 2006 to see much stronger prices for corn. So I think these are encouraging signs. They're signs that we may be turning. We're not there yet, but we may be seeing the early signs of some turn towards better inventories, and especially if we get a year where world weather isn't quite as favorable.
And I guess maybe one concluding comment, the other thing that the chart's reflective of is strong income growth around the world, fueling those increases in consumption. So that continues to be an important factor here, right?
Absolutely, absolutely. And again, we've got to have demand that's growing, usage growing more than our supply growth. And for corn, for the 2 years, and wheat for this year, that's what we have, more usage than we have production.
All right, let's take a look at a futures-based price chart. This one's for corn.
Yeah, just talk a little bit about sort of the outlook going forward. We have strong premiums for later delivery into the late spring and summer for both corn and soybeans. So we're just going to go out and look at the July futures rather than observing back here into the March or the May futures. A couple of things I think we get out of this visual. This is 1 year of time, goes back to early 2017 through the current time period on corn, July corn futures. And what we saw last year, early in 17, was corn got into a sideways trading range in terms of prices. We've been looking for that this year as well. When you have high inventories, generally you just don't go down to the bottom and stay there. As we get into January, February, March, we tend to get into a sideways trading range. We thought that range back in August, September would be 370 to 395 on the July 18. And then as we went through the fall, USDA asked farmers how their yields were, and farmers kept reporting those yields are better than we expected. So the consequence was the typical large crop year. The later we go in the fall, the bigger the crop got, until we got to record yields in terms of as we got into November and December, and you can see falling below that 370. So where we end up in a trading range, we've been down to about 363 on the July futures. But I think, we'll probably see some positive news through the winter. We get up maybe to the 385 range, and that's where we're kind of targeting something in the 365 to 385 range as the trading range, the best guess at this point. So we're talking about the kind of rally, the 15, 20, 25 cent rally is about as much as we think we can see in this market until something more major changes. Can we get up to that 395 on the July? Well, probably is going to take some weather event in South America or an acreage report, planting intentions that shows a cutback in acreage in the United States of corn. So modest increases. And as we say, these are the lowest prices that we've seen, at least for a marketing year price, for 11 years on corn. And I think these will be the lowest marketing year price we'll see, which at 320, USDA is at 320 for U.S. prices, we'll see in the next 5 years. So I'm talking about these are the lowest prices in 16 years possibly right now. I'm trying to get some of those investors in New York to shift into buying corn futures, right?
You've shifted into salesman mode, huh?
Into salesman mode.
All right.
So, everybody knows these are really low prices.
That's right. So
And Michael's going to help tell us that when he looks at cost.
Let's take a look at soybeans.
Soybeans, we just kind of briefly look at the July futures. Again, good premiums for storage on out into the late spring or early summer. This is the last year trading on the July 18 soybean futures. And clearly some different patterns, much broader range, 940 to roughly 1040, although the highs on July 18 futures are about 1060 over the last year. First thing we note is over here on the right-hand side that we retested that 1040 range back in December. So we had been targeting 1030, 1040. You have some orders in at that range if you get to that point, and we did test that. Now this was the concern on particularly Argentina, the dry weather and delayed planting in Argentina that got that bean market excited. Improvement in the weather since that time, and now where we see beans basically trading at the midpoint of this dollar range we've had over the last year. So as I tend to think about where beans are at, we have major U.S. government reports coming out from USDA a week from today. If they should raise the bean yields and bean production a week from today, and I think a second thing, exports are just not going as well, our export sales on soybeans, as what USDA had intended or had projected. They lowered those export expectations in December, and the trade's talking they'll lower them again in this January report in a week. If you see higher production and lowering of exports, you're going to increase the carryout, and I think soybeans are going to retest that 940. Now, that was two ifs in there. If that does not happen, we've got some deterioration in weather now to talk about in South America again. Then I think it's reasonable, if we get through this report without a bearish report, that we will see some weather event that will give us a chance to retest that 1030 to 1040. Now, it depends what your basis is, but sometimes typical basis at processing plants might be close to option price. That would feel pretty good, up above $10 for soybeans, and even locations now are bidding some non-ethanol plants 20 to 30 under, but I think that basis probably will be a little stronger than that. Still a chance we'll get $10 soybeans. Cash opportunities once again, with taking the risk going through the report next Friday that we see a bearish report.
All right, let's take a look at
that's basically just saying what I said is soybeans could be either at the low of the range or the high of the range.
Right, yeah.
But there's the range, so wasn't that a big contribution that I provided?
Plus or minus 50 cents.
Yeah, plus from where they are today. That's the forecast.
Let's take a look at some longer range planning prices, because I think really we've kind of wanted to lay the groundwork, I guess, not only for 2018, but looking ahead beyond 2018. And you've taken a look at not only some recent prices, but actually taken a stab at looking at some potential marketing year average prices, not only for 18, but looking out even to 19 and 20. And there's a pattern in those prices. Let's talk about that.
Yes, that's right. And again, we'll start with 2012. That was the record high price for U.S. average prices or marketing year average prices that USDA determines, near $7 on corn and over $14 on soybeans. It's been downhill since then. There's your 5 consecutive years of declining prices of corn. The yellow background indicates the lowest yearly price of any of these showing. So that's this 2017 crop at $3.20 a bushel. For the 18, 19, and 20, what I do is go out and look at the futures that are trading for the 18, 19, 20 crop, make some historic basis adjustment, and then come up with at least an estimate for a marketing year average price. And what that is showing is if futures are correct and a historic basis would prevail into the future, that we're looking at the improvement coming on corn prices in the fall of 2018 as we moved higher prices for that 18 crop at $3.70 a bushel on to $3.90 a bushel for the 19 crop and $4 then for the 2020 crop. The consequence of getting higher corn prices is that at least worldwide we shift more acres into beans, we reduce corn acreage, and that helps clean up this inventory and move us up on corn prices. Consequence being beans, we don't recover much. We stay in the $9.50 range going out into the 18, 19, and 20 crop. Corn and wheat move in the same general direction, but Indiana, obviously, Eastern Corn Belt, dominated by corn and soybeans. So better revenue comes from corn.
Just a couple things there, Chris, to keep in mind when we're looking at break-even charts here in a couple minutes. Is you look at your corn seems to be heading to $4, where beans are kind of heading to $9.50. That's a little different relationship than what we've seen the last few years.
Correct.
And so that's going to impact acreage decisions. And also that corn price, as we're going to see, that long-run corn price there at $4 is getting much closer to a lot of people's break-even, particularly in higher productivity soil. And so that's certainly a good sign. When we're looking at future incomes.
Right, and cost today, maybe opportunities to try to still work on driving, at least try to work on driving costs lower. So the source, my source of better revenue comes out of the corn market. And will that or will that not occur? That's still to be seen.
So you've taken these prices and used those to project revenues and also compare them up with cost for a typical Indiana farm on average quality farmland. Let's take a look at that chart.
Yeah, half corn, half beans. Again, on the right-hand side, the low point of the red line, revenues, is 2017 crop, $571. Then we begin to see the red line improve in 18 and 19. What drives that? That's the higher corn prices, where futures markets are telling us pretty flat on beans. So higher corn revenues. And then the blue line is cost of production that Michael works on. And he has the 18 numbers. But then the 19 and 20 are my projections, trying to drop costs maybe 2% a year. The point of that is to say that we get back in better balance. Red line's revenues. The revenue's been sharply below Michael's total cost. That by the time we get to the 19 crop, we get more close to an equilibrium of total cost and total revenues. Now, that's a hopeful sign. It's based upon better futures anticipation on corn. How will 18, 19 play out? At least this provides us with a little bit of hope that there's some justification for saying that we've been through a lot of the adjustment and things will get somewhat better over the next couple of years.
So the gap between the blue line and the red line really displays or kind of gives us a picture of the problem we've been facing in crop agriculture, right?
That's correct.
That gap has been filled largely by people pulling down their working capital, and that's created the challenge for many farms after this many years of having cost exceed revenues by the magnitude that we're looking at on that chart.
That's correct.
That's really created the problem. So Chris, you've painted a picture of at least some possible reasons why we could be a little bit optimistic about commodity prices. One of those you mentioned earlier was weather. Let's take a look at a fairly recent chart from USDA, or actually from the Drought Monitor at University of Nebraska. It suggests there's still some problem there is.
Yeah, a couple charts here. The one on the left is a composite of several different models that National Weather Service uses for South America, and it is precipitation for Jan, Feb, and March. The brown is the below normal precipitation. We see that particularly in northeast Brazil, not their prime soybean production, soybean and corn, but some production up there. And then lighter brown down in Argentina, where anticipation that the dryness already has caused some damage, some loss of crop, as well as a continuation of some tendency towards dryness. So I think we'll probably hear talk now in the next 45 to 60 days about South America. It's certainly not over there yet. The delayed planting in Brazil on soybeans, on some of their double crop corn, some private people are already saying that crop, they're just not going to be able to have the acreage of double crop corn. And then the map of the United States on the drought monitor on the right that Jim mentioned, the southern plains is the area we're going to be watching this winter, and that is the hard red winter wheat crop, already the lowest crop ratings in the last 5 years. Not a desperate situation, but continuation. It looks already dry and probably a continuation of that dryness as we go through the year. And then the Midwest, Iowa, Illinois, Missouri, already droughty soils setting up there. And if you're in producing corn and soybeans in Illinois and Iowa, if you have to have a drought, January is a good time to have a drought. So many people would say this doesn't count, but I think obviously what we'll know is what will winter precipitation be, and then what about the spring? But we're starting off dry in terms of subsoil in some pretty big parts in Nebraska, Dakotas, Iowa, Illinois. So weather, I think, is always part of agriculture, but we will talk weather in South America and the U.S. this winter.
And it could be especially important this year because people are already looking at the possibilities of an impact from, example, La Nina.
That's correct.
Potentially having an impact. And so it's going to be coming off of 4 years of very favorable weather. Are we going to see a repeat of that, or could we pull back from that? And we wouldn't have to have a severe drought to make a difference.
Well, and I think markets are almost lulled into a sense that you're always going to have high yields. When you do that 4 years in a row, your observation is yields always come out okay. Well, history tells us that is not the case.
Right. So, Michael, you have taken a look at some cost and return projections, looking at corn versus soybeans here on low productivity, average productivity, and high productivity soils here in Indiana.
Yeah, this is a chart we've been updating frequently, and we'll update it several more times this spring as we get closer to the planting season. But let me explain a little bit how we derive this chart. It's always important to understand that. The yields are actually up above there. I've got the corn and soybean yields that are assumed. Again, this is continuous corn and rotation soybeans, and so we're looking at whether we'll see more continuous corn than rotation soybeans. It's using average difference of cost in the Purdue budgets. If your corn yields are relatively higher compared to your soybean yields, then these prices here, these threshold prices, would be lower. And so it's important to keep that in mind that we've got a lot of assumptions here. But let's go ahead into the high productivity and look at that $9.50 price. That's where the soybean price has been landing recently. If you look at November 2018 futures adjusted for basis, corn would have to be above $4.12 in order to encourage more continuous corn. That seems fairly high, and so I don't think we're going to see a lot of continuous corn, assuming these numbers. Again, if someone has relatively high corn yields compared to soybean yields, maybe on their ground they'll be looking at continuous corn, but I don't think that's going to be that common. This is not that surprising. We've been talking about this on previous webinars. Soybeans in general in Indiana have been more profitable than corn for the last 4 years since 2014. A big switch from the 2007 to 2013 period where we saw a lot more continuous corn because it was the prices were more favorable towards corn. I think it's more interesting to look at the next chart that actually compares continuous soybeans and rotation corn. Last year in Indiana, we had quite a few more soybean acres than corn acres. That's unusual, but we did see that last year. Will that continue? That's the question. Well, I actually contend that there's probably a little bit more advantage towards corn this year than there was last year. In other words, corn looks a little bit more like it might increase acreage, at least in Indiana, compared to last year by looking at these numbers. And so again, let's look at high productivity here. With $9.50 soybean prices, corn would have to be above $3.79. I think
that could be a possibility. Yeah.
Chris has pointed out a scenario where that could happen. And so I'm encouraging people to take a little closer look this year at your budgets for corn and soybeans, because doing what you did last year may not be the best option. You may want to look at planting more corn, particularly on soybean ground, and that's what these numbers would suggest. Also, these prices, these threshold prices are very sensitive to the soybean price. Obviously, if soybean prices land at $9, it's going to be more advantageous towards corn. On the upside on soybean prices, if it's $10, it'd be more advantageous towards soybeans.
And Michael, let's just kind of back up a little bit in the sense that if you looked at this same chart a year ago, the situation was different because it was more favorable for soybeans than what you're showing on the screen at the moment. That's really the big change, right?
That's the big difference.
In both cases, it probably still tends to favor soybeans, but we don't see anywhere near the advantage this year for soybeans versus corn that we saw 12 months ago.
The budget still favors soybeans, even on higher productivity soil, given these yield estimates and our cost estimates, but it's not as big a difference as it was last year. If you look at average productivity, for example, we're looking at a difference in the budget right now that's more like $60, $60, $70. Last year that was closer to $80 to $90 when we were looking at it, and so it's gotten a little bit. The difference has gotten a little bit smaller, and these numbers also include some relatively high nitrogen prices that we've seen recently. If that would change, it'd be a little bit more advantageous to corn. And so the point I'm making here is it's a little less difference in the profitability. And so it's good to dig out your numbers and put your numbers on paper or in a spreadsheet and see what it looks like for your farm.
Yeah. All right. Let's look at that a little more detail with respect to the contribution margins here in Indiana.
Yeah, a couple things here I wanted to point out. We've already talked about the difference between corn and soybeans. It still favors soybeans on the low, average, and high, but not as large as the numbers looked like last year and 2 years ago for that matter. We're still looking at some negative margins. The negative margins are much smaller on the high productivity soil, so we're getting much closer to break even on the high productivity soil than we are on the low and average. That has implications on cash rent negotiations. There's still much more incentive to negotiate cash rents on that low to average productivity soil than there is high productivity soil because the margins are quite negative on the low and the average productivity soil. The other thing I did want to point out here is as you move to the average and low productivity, the advantage to soybeans is larger.
Yeah, so maybe just pointing out a little more detail on the chart, Michael, you've showed the contribution margins for both corn and soybeans across the different productivity categories. And in each case, those contribution margins are not enough to cover the overhead, right?
No.
And I think that gap is really the projected loss based on the budget you've put together, and no matter which productivity level you look at. And then the second point there is how much larger that gap is on the lower productivity soils versus the high productivity.
Now, these charts also use trend yields. We've been talking about the favorable weather the last few years has made these margins less tight than they would have been otherwise, and so it's important to point out that these are using trend yields. If we would move more towards average weather, to the extent we ever have average weather, these would be your
typical, more reflective of that,
typical margins.
I'll just throw out one other observation. I'm looking at the average on corn, $194 contribution margin for corn on average quality. We're approximating the cash rent on that land at $195.
Yes.
So talking about narrow margins, on your corn budget for 2018, you generate on average quality land $194 of return, and you give $195 to the landlord. You need to go get $1, and that's no contribution for the machinery that the farmer put in,
or the labor.
That's no contribution for the labor they put in, or the risk that they take.
Yes.
Zero.
Yes.
Actually, minus $1.
Yeah.
These are tight margins.
Yes, and then the high productivity, it's still tight, but it's less tight. There we're looking at a cash rent of $246, and so there's $50 that are contributing to the machinery.
What about
and
over
labor
on the
in
low
that
quality
case.
land?
That's actually a very
We've got about $150.
Yes, that's a really bad situation because you got cash rent $150, $160 there, and you're not even covering the cash rent.
And so here's your point that the cash rent or rent needs to come down much more on the average and low quality land.
And that's been consistent. Our budgets have shown that for several years, right?
They've shown it for several years, but it's actually given the changes in cash rents, it's actually been more glaring today than it was even a year, 2 years ago.
Yeah, good point. Let's look at those break-even prices for both.
Because the margins are tighter for low and average, you'd expect the break-even prices to be higher. Let's talk a little bit about what VC and TC means here, Jim. The blue bars are to cover variable costs, and so that's your fertilizer, your seed, your repairs, your fuel. Obviously, we're going to be able to cover variable costs, and so we're going to continue to produce. But it's going to be difficult on the low and the average to cover all of the costs, and so very low returns for machinery ownership, for land ownership, for labor. A very, very tight situation there, particularly for low and average. On the other hand, that high is getting closer to some of the prices that Chris was talking about, and so that's why we think we're going to see a kind of a convergence here between cost and revenue. This is for 2018. As you move to 19 and 20, and corn does go to $4, we're going to be right at break even on the high productivity, but not on the average and low, and that's why I wanted to show the average and low in addition to the high. We've still got some challenges there, some very large challenges on that low and average productivity soil. Soybeans, again, this is using trend-adjusted yields, and some people are probably scratching their head out there. Well, I know my total cost of production for soybeans is below $10. You're probably right. Using relatively high yields you had last year, and particularly 2 years ago, your total cost per bushel probably was under $10. But if we have average weather, total cost of production to produce soybeans, even on the high productivity, is closer to that $10 per bushel figure, and much higher for the low and average productivity. Again, obviously we're going to be able to cover variable costs with no problem. It's just we're looking at some very low returns for machinery and land ownership and labor.
So let's talk about some strategies here, Michael.
This is a chart we've been using frequently because I think it does a nice job of summarizing the different levers that you can try to maneuver to reduce per unit costs. Reducing variable or fixed costs is going to have a positive impact, or is going to lower your total cost per bushel, but also increasing yield. And so we're looking for things that reduce variable costs without impacting yield. That's very important part of that sentence, without impacting yield. You don't want to impact your yield adversely. You need to look at the benefit and the cost. And so we've been talking a lot about looking at seeding rates, looking at fertilization levels, fertilization timing, examples of that. Reducing fixed costs, what we're primarily talking about there is cash rent. But let me tell you, two of the fixed costs that vary tremendously across farms are labor and machinery costs. If you haven't benchmarked your labor and machinery costs recently or ever, this is a good time to do that. What are your labor costs per bushel? What are your labor costs per acre? How do those compare to some of the benchmarks that are out there? The same with machinery. Because if you have higher labor and machinery costs, your margins are going to be even tighter, and it gives you even more pressure to reduce some of these other costs or increase yield. And so you definitely need to do that in addition to negotiating cash rents, and then looking for opportunities to improve yield without increasing variable or fixed costs. I know that's difficult, but certainly we don't want to not mention that lever.
So I'm going to give a plug for our Top Farmer Conference, which we're going to mention at the end, but that's coming up next Tuesday. We've got a session focused on this with Purdue's top crop production scientist from agronomy and plant pathology. So opportunities there to think about using the best technology to reduce your production costs.
And they'll be focusing on three relatively large costs: seed, fertilizer, and pesticide. And they'll be talking about different ways you can possibly reduce those costs without impacting yield.
Yeah, some good management strategies. So that'll be at the Top Farmer Conference, which is next Tuesday here at the Beck Center in West Lafayette.
I don't think we need to belabor too much because I think we've talked quite a bit about cost of production, but I wanted to put this slide in there to encourage you to compute similar numbers for your farm. You know, what are your costs per bushel for land, machinery, fertilizer, and seed? Do they compare favorably or unfavorably to the numbers that we've got on this screen? And again, using trend-adjusted yields, these break-evens are still higher than the 2018 prices. These are closer to the 2020 prices that Chris was talking about for corn, and the break-even here is higher than the 2020 price that Chris was talking about. And so, in some ways, there's even more important to reduce soybean break-even price than there is corn looking ahead 2 to 3 years. And so just to encourage people to compute these for their own farm. This is a chart that looks at net return to land, and so all costs are included except for land. That's why it's positive here for every single year. And then also looks at the cash rents. And so if you look at that 2007 to 2013 period, obviously our net return to land was higher than cash rent. We were earning what economists call economic profit, covering all costs, including opportunity costs. That's a little bit unusual to see 5-6 years in a row like that, and so we did a nice job of building up liquidity during that period, and it's really helped us cushion the blow from the lower prices since 2014. Obviously, since 2014, cash rent has been well above the net return to land, and so that's why we've had the pressure to reduce cash rents. In West Central Indiana, cash rents have came down approximately 17-18%. If you look at average productivity of land across Indiana, that number is smaller. And so the natural question is, what do we expect to happen in 2018, 2019? Despite this chart, we're expecting relatively small adjustments to cash rent in 2018. Based on what we hear and based on the ag economy barometer, some optimism out there towards production agriculture is we think there might be still room for a downward adjustment, but probably relatively small in 2018 compared to the adjustment we saw from 15 to 16 in particular.
And that's consistent with what we've been picking up this winter with respect to some of the auction results and some of the other conversations we've had. Iowa State recently released its land price survey here just a few weeks ago and suggested that statewide there was actually a very small increase in land prices in Iowa. There were some small number of counties where they had some reductions, but statewide I think up about 2%. Chris, I think you pointed out earlier that one of the differences between Indiana and Iowa was prices have come down more sharply in Iowa from the peak than they have in Indiana.
Right.
So that modest recovery might just be a little bit of a rebalancing. But nevertheless, it is indicative of the fact that there is this strong underlying support. And we've picked it up as well in our Ag Barometer surveys. So we're expecting to see modest declines, if anything, I think, with respect to land values on the next survey and maybe with respect to cash rent, which means there continues to be pressure to find other ways to reduce cost per bushel.
Yeah, we don't have a chart for land values in Indiana, but it's very similar trend to cash rent the last 4 years. The percentage declines have been almost 1-to-1, looking at cash rent or land values. Looking ahead, besides net return to land, some things to think about when you're looking at land investment is what's going to happen to inflation, what's going to happen to interest rates. I wanted to come back to some things that Chris was talking about earlier. Land is typically a very good inflation hedge, and so higher inflation would tend to support land prices. On the other hand, higher interest rates has the opposite impact. It would temper and mitigate any land price increases. And so in addition to net return to land, it's also very important for farmers and other people looking at investing in land to think about what's happening to inflation and interest rates. And so we might not necessarily see that direct correspondence with cash rent and land prices as we see inflation and interest rates change.
All right, let's talk a little bit about some management philosophies for 2018. And obviously, we continue to have tight margins, Chris. We've been in that mode for several years. 18 is going to be another year of tight margins. We've painted a picture that suggests margins could start to improve in 19 and 20. It's not guaranteed, but we think this 17, 18 timeframe could be the bottom in terms of the tight margins?
Right, and we've had a number of years of adjustment. People have adjusted. They've adjusted their family living expenses. They've adjusted their capital purchases. They're finding a way to hold things together as best they can in these tight margins. And what we know about business cycles, we know about economics, it is a science of adjustments, and that we are making progress to trying to drive our costs lower. And the world is beginning to consume more than what it produces. So those are all positive signs. Are we there yet? No. But I think they're positive signs that we will get some, at least we can continue to hope for improvement in the next couple of years.
The second point is, look, you mentioned modest price increases, and actually along with that, one of the things that we've been talking about, and actually we'll have a session at Top Farmer next week talking about this, is structuring your marketing program in a way that you can earn those market carrying charges, which we tend to see when we have large inventories. The grain industry has to effectively provide an incentive to store, and the question is, as a farm operation, are you capturing that incentive to store? And there's some strategies you can use to do that. Also, maybe capture some basis improvements. You and I working with Dr. Nathan Thompson in the department, plan to unveil a website next week to help us do a better job of forecasting crop basis here in the Eastern Corn Belt, not just Indiana, but the entire Eastern Corn Belt. So there's some opportunities there. If you haven't been taking advantage of that, you need to look into that a little more carefully, but there have been some opportunities which can help you get those prices that you're earning back closer to those break-evens we're talking about.
Well, in a market, we can only take what the market will give us. And when you have, as you point out, high inventories, the market generally builds strong carry. Carry means higher premiums for your storage and selling at later dates. So understanding how to earn that carry, maybe even lock in that carry, is really important. And that's what the market does offer. And so we can take what the market offers us.
A lot of farms in Indiana have invested heavily in storage facilities in the last 10 years. So the question is, are you taking advantage of those facilities in a way that allows you to earn a good return?
Well, Michael, you talked about controlling cost. And as I think about where we are, we're 4 to 5 years in this adjustment. And that message has reached every farm, and it really did 2 and 3 years ago. They're continuing to work on cost. But how do you work on preservation of capital? That one seems harder.
Well, let me talk a little bit about the cost control, because really that's been a kind of a success story for agriculture. We've taken 40 to 50 cents per bushel out of corn break-evens.
Made progress.
So we've made progress, and that's with wheat problems that we're having with soybeans and but also corn, and so that's been a kind of a success story. Is people have reduced their costs. It's more challenging as you continue to try to reduce costs. It gets more challenging because there's not much low-hanging fruit out there. Not that there ever was too much of that, but there's certainly none of that left. But when we start thinking about preserving capital, here we're looking at two different types of capital. First of all, we've been talking a lot about preserving working capital. That's what carries us through these low prices, is having some liquidity, having some grain inventories, sources of liquid funds that we can use to pay back loans and to pay bills. That's very important. We're going to have a session at Top Farmer to talk about liquidity preservation and use of liquidity, but also preserving capital. We want to make sure we make capital purchases that there's clear benefits of what we're purchasing that outweigh the costs. And so when we're buying machinery, for example, we're buying land, we want to make sure that the benefits from that purchase is going to outweigh costs. And so not just looking at tax management, we need to look at what are the potential earnings we're going to achieve from buying this new combine, from buying this tractor, and just being very, very cautious with our capital purchases. Capital purchases obviously have declined dramatically in the last 5 years, but at some point people are going to have to start building up capital, and when you start looking at buying machinery again, just be cautious. And because you want to preserve that liquidity and make sure that everything is paying for itself.
Michael, that feeds right into the next strategy, which is thinking about making sure you get through 2018. We've been through several challenging years. We've painted a scenario that suggests that we think there's a prospects for better returns, better margins after 18. So make sure you are positioned to take advantage of that as 19 and 20 roll around.
How to be able to be on the farm in 18, 19, and 20. We've got to get through 17 and 18 early part. And so again, this is a little more, I think, as you think about your management, it is different managing for the future versus managing, I make sure I get through this year, and then there'll probably be better opportunities down the road. So it does change a little bit, makes us more conservative. We take that 20-cent rally, or at least some of that 20 or 25-cent rally, rather than saying this is the year the big change is going to come.
So we've painted a scenario about 2018 and 2019 being a little stronger, based in part on expectations for perhaps pulling down those inventories a little bit on a worldwide basis and leading to some strength, especially on the corn side, not so much on the soybean side. And then the last point is one we've made before, Michael, which is know your financial position and work closely with your lender. That's really about getting through 2018 in many cases. So if you haven't been doing that, obviously you need to be doing that.
But I do want to emphasize the importance of benchmarking, particular labor, machinery costs, but just total costs and in relationship to gross income. I know it's lower than what it was in 2012, 2013. Of course, it's lower. But what does it compare? How does it compare to the Illinois FBFM average, for example? That's very important in today's environment to do those comparisons, because if you do have relatively high costs, labor, machinery, or total costs, you need to think about what are my strategies to remedy this situation, because I'm going to need to remedy this situation long term to be competitive. And so now is a really good time to put together some benchmarks for your farm.
And I guess, following up with that, Michael, it's difficult to manage your cost in a vacuum, right? If you don't know what the rest of the industry is doing, it's hard to know how good of a job you personally are doing. And that's really, I think, one of the key benefits.
And one of the things we have in agriculture is it's hard to find benchmark data in different industries, but I think in agriculture we actually have some pretty good information, and we've got some information on the Center for Commercial Agriculture website of benchmarks for different financial ratios that are available for people, and talks about how they calculate some of these ratios. And so take a look at some of those financial analysis documents we have on the Center website.
Okay. And so with that, we're going to wrap up, but we wanted to invite you to consider attending the Purdue Top Farmer Conference coming up next week. That's on Tuesday, January 9th. You can still register for that. You can access the registration information from our center website. The address is on your screen. You can also look at the entire agenda. We've mentioned a couple of the topics that will be on there, but take a look at the entire agenda. I think you'll find it to be we think one of the best management conferences for agriculture available in the nation. So with that, we want to thank you for joining us today and wish you the best. Thank you very much on behalf of the Center for Commercial Agriculture and Purdue Extension.